The US national debt has just jumped by $2 trillion within the last 12 months. To put that into perspective, it took 2 whole decades from 1966 to 1986 to add $2 trillion to government debt. What once took 20 years now takes 12 months. This is probably the single most important chart in financial markets today. Most people understand that this cannot go on forever, and we're going to look at exactly how close we are to a complete debt implosion. This is what a typical debt cycle looks like. We have a gradual increase in debt where we actually see short-term benefits from debt accumulation. This can last for years or even decades. Then once debt levels become too great, a phenomenon called the debt doom loop occurs. This pushes the government into a crisis, and that's where things begin to unwind. Eventually, depending on how well the crisis is handled by the government, the economy usually recovers. Now, you might be wondering where the United States currently stands on this sketch. We can look at a specific example of a debt crisis to help us come up with a precise answer. The Greek debt crisis of 2011. Between 2006 and 2009, Greece's government debt rose from 215 billion euros to nearly 300 billion euros. This was a period where many people were already concerned about the high levels of Greek government debt. But when you look at the Greek treasury bond market at the time, it was very steady. Greek bond yields were staying flat at roughly 4%, which are pretty normal levels for a developed economy. Then, all of a sudden, a tipping point was reached in 2010. Within just a few quarters, Greece's 10-year government bond yield surged from 4.5% to 35.5% by the end of 2011. This forced the Greek government to restructure its debts and significantly reduce its spending over the years that followed in order to restore confidence in the Greek treasury bond market. This is what we call the third phase of the debt crisis, the aftermath. And that is where the real pain is felt by ordinary people. In Greece, this phase really lasted from 2011 until 2015. Over the course of that time period, the Greek unemployment rate rose from 12% all the way to 28%. These are levels of unemployment that mirror what the US witnessed during the Great Depression. Between 2011 and 2015, the Greek economy contracted by 30%. This is a direct result of the debt restructuring that the Greek government had to go through in the aftermath of the crisis. So let's recap the 3 phases of a debt crisis. First, we have debt accumulation. Here, the treasury bond market is steady, interest rates are low, and the economy continues to function normally. This phase can last years or decades. Then we have a tipping point. This is when debt reaches excessive levels, investors begin to lose confidence, treasury bond yields start to rise, making the cost of borrowing spike for the government, consumers, and businesses. This forces the government to respond. It restructures its debts, cuts spending, raises taxes, which leads us to the aftermath when the consequences hit the real economy, unemployment surges, and the economy contracts. So we're going to see where the US currently stands on this sketch and whether we should expect a similar painful aftermath to Greece. The size of the US government's debt is currently 100 times larger than the Greek government's debt in 2010. So at a first glance, you might be thinking that the US should already be at the tipping point just based on how extremely large the debt is. But it's not that simple. What really matters is the size of the government's debt relative to the size of the national economy. And today, although the US debt pile is scary big, the size of the US economy is also quite incredible. So currently, US debt sits at around 124% of GDP. This is high by historical standards, but when we compare that to the Greek government's debt to GDP level, we see the US is actually still below where Greece was in 2010. Back then, the Greece debt to GDP ratio was at 180%. So the US isn't there yet, but it is heading very rapidly in that direction. One of the main reasons for that is because the US is running a historic budget deficit. This simply means the government is spending more than it earns. And the only way to cover that gap is by borrowing money, which is why the level of debt is climbing so quickly. This chart shows us that the US is currently running a deficit of around 6% of GDP. The only other moments in US history where the government was running a deficit this big was during periods of war. COVID-19 and the Great Financial Crisis were supposed to be temporary exceptions of large deficit spending. But here we are in 2025 without a pandemic, without a banking crisis, and without a direct involvement in a war, and the US government is maintaining a historically large budget deficit. And official projections from the Congressional Budget Office suggest the deficit will only widen from here. In fact, the CBO estimates that taking into account the recent spending bill, the US government will be hitting a debt to GDP ratio of 150% 1% by 2034. This is the level that many economists consider to be the danger zone. According to research from the Center of Economic Policy Research, once debt levels cross 150%, like Greece did in 2011, a country risks entering a doom loop. This is where a debt crisis becomes extremely likely because interest costs on the debt are rising faster than the government can cut spending or raise taxes. At that point, the government is just accumulating debt in order to finance more debt. So investors naturally perceive this as risky, leading government bond yields to rise, which leads to higher interest costs, which leads to an even larger budget deficit and more borrowing, and so higher interest rates. This is the spiral that pushed Greece into a debt implosion within the space of a year. So in regards to the exact timeline of when a debt crisis will start in the US, as you can probably tell from this research, it's quite difficult to pinpoint. Things could already begin unraveling tomorrow, or they could begin unraveling in 2034. What is certain is that if things continue as they are, a debt crisis will materialize. But there is one aspect that will make the US government debt crisis substantially different to what the Greek debt crisis looked like. Greece, as a member of the Eurozone, does not control its own currency or central bank. It could not print money or devalue its currency to manage its debt. This severely limited its ability to respond to the debt crisis. In contrast, the United States government issues its debt in its own currency, the US dollar, and the US Central Bank, the Federal Reserve, can theoretically print money to buy unlimited amount of US Treasury bonds to avoid this full doom loop. So in the event of a debt crisis, this may reduce the impact on unemployment and GDP in the aftermath of a US debt crisis. On the other hand, it would increase inflation, and it would also likely cause a decline of the US dollar against other currencies. This is a path that the US administration is already pursuing by pressuring the Federal Reserve to lower interest rates and adopting policies that will weaken the US dollar. Although a full debt implosion may not be imminent, we think assets like gold and Bitcoin are already benefiting from major tailwinds as a result of this situation. We currently have open trades on gold mining stocks such as AEM that we think have substantial upside in the months ahead. If you want to follow our strategy to go through this macro environment, you can click on the link down below and try our membership. You won't regret it. Thank you for watching.